but we'll kick things off. As Dan loves to say, live at 5. And today it's live at 5 in the U.S., New York time, and it's live at 5 where Ben is, which is across the world in China. So we're very excited. We have a great show today. We're going to talk about China and China tech and what's the opportunity and what are the misconceptions and all that good stuff. I'm Cynthia Murphy, head of research for the ETF Think Tank. I'm glad to be here, and I love that you guys always join us. Dan, you want to introduce yourself, and then we'll let Ben.
Sure. Dan Weisskopf here, otherwise known as the ETF professor, also lead ETF strategist for the ETF Think Tank. And of course, other hats include portfolio manager at Tidal Financial Group and the portfolio manager of the blockchain fund. Lots of hats there, Ben. Thank you for joining us.
Yeah, Ben, tell us about yourself and MSA. Give us a little bit of the lowdown.
Sure. I'm the managing partner of MSA Capital. We're a historically private investment fund management firm focused on early and growth stage, largely technology and life sciences companies here in China. I've been in China living on the ground full time for the last 7 years. And prior to that was kind of commuting in for the six or so years before that. And first came to China as an intern for Motorola's strategy group in 2004. So a long time on the ground here.
Yeah, what I think is so cool, and it's going to be so cool about today's conversation, is this boots on the ground, which is such a bonus when we talk about any place that's not the U.S. And we talked a little bit before the show started, and there's this idea that we kind of misunderstand China and the opportunity, or we misrepresent China and the opportunity. So I'm just really curious, set the stage a little bit in terms of just the big picture for China business, for China entrepreneurship, starting businesses there, growing businesses there. What is it that we don't understand or get wrong from where we sit?
Yeah, I think China is probably the biggest kind of arbitrage trade of maybe our lifetime. And a lot of that is driven by this lack of understanding around China, driven by all kinds of different factors. I think there's fault on both sides of the Pacific for that wall that has been created. Some of it is due to just overall U.S. apathy towards China. We're at historically low levels, even before COVID, of Americans studying Mandarin, Americans studying abroad in China, working in China. And of course, over the last 3 years, those numbers collapsed almost to zero, at least when it came to people studying China. So you had 3 years where no China watchers, be they economically oriented, politically oriented, culturally oriented, spend any time on the ground here and are only sort of tacitly coming back. And so, as it is a market, many of those that were trading China or writing about China, be it in the media again or on Wall Street, were not sitting here physically. And that just exacerbates that lack of understanding. A lot of the major media outlets that report on China were doing so with journalists sitting in Taiwan or in Korea or Japan, or of course the United States or Australia. So and then there are certain kind of, I call them almost biased narratives that seem to permeate the way that China is described in economic or political media. So the net result of that is just a hugely misunderstood, often misrepresented market that remains, arguably the world's second or largest market across multiple metrics, and will be so for the foreseeable future.
But so is it a myth that China is not that receptive actually to foreigners, or that they're watching what we're saying on social media, and if you say something negative and you show up in China, there could be backlash? I mean, is that all just a big myth? You think we exaggerate the reality of a foreigner in China?
Yeah, so there's the narrative around, China not wanting foreign direct investment, China not wanting to receive kind of global capital, making it hard for global investors, is largely a myth. In many ways, actually, China has not only created all kinds of different channels for global investors to bring their capital onshore, be that through what we call a VIE structure, which was a way that a lot of global investors injected US dollars into private local operating businesses by investing in their offshore entities. This was how the likes of Alibaba and Baidu and others raised their initial seed capital before going public on global, oftentimes US exchanges. Likewise, there are things like the Hong Kong to Shenzhen or Shanghai Stock Connect, which enables global public market investors to access onshore markets. And particularly today, post the end of zero COVID in China, we've never seen such aggressive actions being taken by Chinese financial regulators to try to court global capital through all kinds of measures, including what we call WOFIs or QFLPs or QFIs or other structures that enable them to easily onshore and then offshore that capital at exit. And so I think that a lot of those narratives around how difficult it is to access China and how unwilling China is to kind of receive global capital and global investors is misguided. Certainly, zero COVID created a significant barrier physically for that, although capital was still flowing freely over that period. But it's one that's really accelerating and opening up post the end of zero COVID.
So Ben, can we take a step back? Because for those who don't know you, right, I find it extraordinary that you won the exit of the year for all of Asia, beating like some of these major firms. Can you put some context into that? And now that everybody's joining us, so they know a little bit more about your success.
I didn't do it alone, and I certainly wasn't the sole individual responsible for any of these. We've got a great team here in Beijing. We've got 30 investment professionals covering all kinds of disciplines, and very few of us are non-Chinese nationals when it comes to kind of the investment side of the business. The deal that won us exit of the year for all of Asia last year per Private Equity International was a transaction where we bought 10% of a company called Boss Ziping. Some of you who trade the public market in China probably know that name. This is kind of the Indeed or Monster.com of China, a mobile-first hiring recruitment platform. We bought 10% of it at a $36 million valuation. And the company since reached valuations in the public markets of around 16 billion. It's down a tick from there today, but it's still held up quite well. And that was actually only one of several transactions of that magnitude. We were one of the first and largest institutional investors in a company called NEO, which grew to, at a time during kind of that COVID craze, stock craze, reached as high as almost $100 billion in market cap, and was at one point, I think, the second largest car maker in the world, or third largest car maker in the world. So, we've had a whole slew of transactions like that. But the ability to find deals like that rests with a lot of our incredible partners on the China side, who were some of the nodal figures in the China venture and growth equity ecosystem. So founders of the China Venture Capital Association, founders of some of the earliest financial advisory groups in China, founders of some of the earliest angel investing salons that brought the likes of Jack Ma and others together and connected them with global investors at a time that where China had no domestic fund management ecosystem. It was, I mean, the crazy thing to think about is the biggest funds in China only were created around 2005, 2006. And so prior to that, the only sources of capital in China were really coming from the global Pan-Asian, Carlyle, Warburg Pincus, TPGs of the world. And it's only very recently that we've developed a kind of a native fund management ecosystem. And so many of our partners were part of that nodal group. We also now have a team of young partners who I'm really excited about, who lead a charge in kind of this China to the world narrative. And we'll get into it probably later, but I mean, if you go on your US App Store today, you'll find that 4 out of the 5 top apps in iOS are Chinese built. And that's because China has perfected the art of taking its companies global and building models for kind of digital native consumers. And so we've built a team of young investment professionals who are now become partners, who kind of understand this narrative of China to the world, what products out of the consumer life sciences and enterprise spaces from China have global applicability. And so as a unit, that's what's, brought us accolades like Firm of the Year for China last year, beating out many of those names I mentioned, like Warburg Pincus or TPG, who were kind of the earliest entrants to the market from a private capital perspective.
And for those who don't know, the word of the day, by the way, is decoupling. And you chose that word, Ben. Why did you choose that word? Are you expecting there to be a decoupling between us and China?
Decoupling permeates everything we do these days in Chinese technology and life sciences investing, both on the public and the private market side. It is something that it was a term that I first encountered, I think around 2017, sitting in the White House with some of the members of the National Security Council, who outlined this initiative at that time through the Trump administration to decouple the connectivity between the United States, both in terms of or in terms of supply chains, capital markets, overall capital flows, talent flows, and a lot of the other kind of core economic linkages between China and the United States. And a lot of it finds its roots in kind of this existential battle for kind of economic supremacy between the two largest economic powers of the world. A lot of it rests also in that kind of technological battle as well for supremacy. But it permeates its way into everything we do, and it affects what we do negatively and positively. It certainly hurts certain sectors and certain sources of capital and segments within the Chinese market, but also provides really unique opportunities for those of us that invest in China, because it has generated a parallel universe of Chinese companies that have Western precedent or Western equivalents, but access a very different consumer base, both geographically as well as sometimes from a kind of an economic tier perspective. And so it enables global investors to kind of double dip and have exposure both to China and the United States. And particularly in an environment like today, where we're seeing a pretty challenged kind of US economic outlook, that decoupling now has led to a China that is in a very different place in this economic cycle than the US, which enables us to have a lot more rosy outlook, for instance, for 2023 than we would in the US, because we don't have all those kind of negative symptoms in the ecosystem, like high inflation, the necessity to raise interest rates, some of the kind of other key economic indicators we're worried about. We don't have those in China. The Chinese government has a lot more levers to pull to stimulate growth now coming out of zero COVID. So I'm sure we'll come up again throughout our conversation, but here's to the good and bad of decoupling. Cheers.
So is one of the good opportunities in decoupling that it creates some kind of arbitrage that you can do between US and China markets and investing? I mean, what's the opportunity for you to capitalize on this break?
Yeah, I mean, to that point around the misunderstanding of China, this decoupling has led to kind of a world of political, media, and economic personalities that understand China all the more less, because of a lot of those linkages have been lost. And it doesn't mean that China is anywhere, declining as a market or an economy. It just means that we kind of appreciate it less in the West. And so what you find today, or over the last year or so, were a series of shocks to the Chinese financial ecosystem, a lot of them very kind of driven by emotional, irrational exuberance from Western investors, and not driven by the fundamentals of the businesses. So I'll give you a simple example. October 24th, 2022, the Chinese market reached almost near record bottoms for most major equities and a lot of the key stocks we follow and trade. And that was that was kind of the first Monday of trading after the Chinese Central Party Congress, where Xi Jinping was reanointed for kind of his latest term. And I think it was partially reading by global investors at the time, particularly US investors, that there had been some kind of replacement of some of the more kind of growth-oriented folks in government, and those were replaced by those that were more kind of loyal to the political establishment. But the reality simply was that for those of us on the ground, that most of the changes were anticipated. There weren't too many, surprises. And yet, in spite of that, and certainly no real effect to the Chinese market, we saw this massive bottoming. And I literally I was on the road at the time, and I was in the car, and CNBC called and said, come give us commentary on this. And I literally said, buy, because there is no reason for the market to be so discounted for us to see these kind of lows. And if you bought at that time, on that day, or even the day or two following it, you doubled your money in most instances within 2 to 3 months. And we're talking about doubling your money on huge positions, on multi-billion-dollar Chinese business. And we're not talking about penny stocks. And so it's just simple kind of moments like that where we've seen over and over again irrational discounting or crashing of valuations and perceptions around the economy that, for those of us sitting on the ground, seem crystal clear and enable us, I think, to really take advantage and make significant returns while those in other markets flee without having a true basis for it.
Ben, I talk to a lot of financial advisors, and I find that the discussion candidly around China is almost bifurcating. How do we, well, let me ask the question differently. What's your vision for China-U.S. relations improving? Because at the core, I think that's part of the, as you put it, the arbitrage opportunity, right?
That's right. I personally spend my time, and outside of business, I spend most of my time on the U.S.-China dynamic. I sit on the board of directors of the U.S. National Committee on U.S.-China Relations with a whole group of incredible, both political and economic folks that come from both sides of the political aisle in the United States and are responsible for a lot of the cross-border trade between our two markets, or were former ambassadors or heads of kind of the China desk of the State Department. So the likes of Henry Kissinger, or Ray Dalio, or Bill Ford from General Atlantic, or others, Ajay Banga from MasterCard, who now looks to be the next World Bank president. The mission that we have is very simple, which is keep the lines of communication open, provide for constructive, pragmatic dialogue, and ultimately, obviously, to avoid a hot conflict. I am not optimistic about the future of this relationship. It's one that is now significantly challenged, and there's kind of a universal alignment on both sides of the American political aisle to continue the current trajectory of decoupling. But the challenge, but there are opportunities. It's not just the opportunity to invest in Chinese stocks that are underappreciated. There is now a kind of a balkanization or a splinter net forming, where there are spheres of influence that are under the control of American businesses and the American government by some degree, and also by Chinese businesses. And there are markets around the world which are still very receptive to Chinese business. Those being in South Asia, Southeast Asia, the Middle East, Africa, parts of Latin America. And that provides a world where you can invest in Chinese businesses, like the Chinese hardware manufacturers, who dominate and have a majority market share across a lot of those emerging next billion markets, which will be the ones that provide the highest alpha for consumers globally, or for investors globally, because they have that much margin for growth. And so on the one hand, it pains me to see that split, but on the other hand, what it means is that Chinese business will actually have greater economic opportunity in those markets. Here's a simple example. Back in 2018, 2019, 2019, 2020, there was a decision that was taken, for instance, by Google to start removing some of its Android operating system from Chinese phones, particularly from Huawei phones. That was a misguided decision, I believe, because when they did that, and they also obviously took out the Google Play Store from those phones, those were phones that dominate and have dominant market share in markets like Sub-Saharan Africa. When you take those out, you essentially remove the American kind of app store access to those customers, and you replace it with a Chinese app store. And when you do that, then you don't have necessarily a channel to feed an African consumer Google search or Uber ride hailing or DoorDash food delivery. And instead you have kind of the Chinese equivalents, portfolio companies of ours like Meituan or others, and they become kind of the dominant monopolistic kind of channels within those markets. And so you know, that provides more opportunities for the Chinese side. So it pains me to see it, but it also creates significant opportunity as that kind of balkanization and splitter net accelerates.
So can we talk a little bit about the tech sector specifically? Because I think a lot of your expertise is in the tech sector, right, Ben? So, you know, what parts of the sector do you think are most undervalued today, or have the most opportunity for growth that is completely overlooked by U.S. investors?
Sure. So we follow probably three core themes that we're most excited about sectorally. So the first is in the life sciences space. So historically, China has built very few, you know, kind of $10 to $100 billion life sciences and biotechnology companies. And that was because historically China was a fast follower, replicating US models and to some degree infringing on American patents. And therefore, a lot of the businesses that were built domestically couldn't expand beyond the boundaries of China. And domestically, they were subject kind of volume-based pricing, which meant that they, you know, had one kind of single customer, which was the central government, and therefore could not push for significant price increases, and therefore they had very slim margins. That is changing now. We're trying to starting to build a whole new generation of first-in-class biotechnology and life sciences companies that can compete on a global scale. And that will mean that you'll see more of kind of Novartis, Pfizer, you know, Moderna equivalents in China, and that will provide a whole kind of new, as I say, $10 to $100 billion group of opportunities for investment that are only just beginning today. Second is in the core technology space. Again, as this decoupling accelerates, it means that China will be building its own set of core technology endpoints, so its own chip companies, its own robotics businesses, its own AI companies. So a simple example would be ChatGPT, which is the, you know, kind of buzzword on everyone's lips today. China banned it very early on, and China is building through the tech majors as well as some independent companies its own parallel ChatGPT ecosystem, and already has several unicorn companies in the space today. And so again, there will be kind of those parallel opportunities. You could invest maybe someday, we'll see how it, you know, works on the public markets, but, you know, or maybe you get exposure to it through Microsoft, but, you know, there will be ChatGPT opportunities for investment on the US side, and there will be kind of a parallel opportunities on the China side. And I think that will be a whole new space, because again, historically, China was lagging the West significantly in the core technology space. Finally, consumer in China was kind of the theme of the last decade. And it was what, you know, created a lot of wealth and growth for other investors in the US and firms like ours, investing in the Chinese market leaders in ride hailing and food delivery and micro mobility and e-commerce. There is now, you know, as I said, this long tail of cross-border Chinese companies that are being built that address mobile native consumer, you know, demands, and are much better suited not only for consumers in emerging markets that have a similar kind of look and feel to China, say 10 years ago, like Southeast Asia or South Asia or Africa, but also consumers in Western markets, like in Europe or the United States. And so there's a long tail behind companies like TikTok and Shein that are going to dominate that American kind of or Western mobile first set of entertainment, financial technology, e-commerce, and communications platforms that will provide for really exciting investment opportunities at very high alpha scale over the coming 5 to 10 years.
Okay, Ed.
So since you mentioned TikTok, I think we would be remiss to not address sort of the perception around privacy and technology when it comes to China. Right now, I tend to be pretty cynical of the views of the US when it comes to that. I mean, we often argue about how China doesn't care about privacy rights, but nobody ever reads the terms of service for US tech-based companies. From your vantage point, what does the West get right and get wrong when it comes to the narrative around the intersection of technology and privacy?
Sure. And obviously, I think it's something that's relevant as a consumer. It's obviously something that's less relevant as an investor, but it's certainly something that we think about a lot and live in this environment. It's always odd to me when I see American businesses or kind of officials, and we saw it in the TikTok hearing, kind of criticizing some of these data privacy issues, because America to a day does not have a data privacy regime. We don't have a GDPR like they do in Europe and other markets around the world. And so until we figure that out from our side first, on the US side, it's going to be challenging, and companies are going to have to kind of, in this case, like we have Project Texas and TikTok, you're going to actually have to kind of proactively go out and set that standard yourself. The Chinese government certainly does have access to anything that's kind of done from a communications perspective here in China, as largely the American government does on the US side, if it really wants to gain access for probably legitimate reasons in the US. But it's certainly one where I think a lot of global businesses are now struggling with how they're going to address the American market. TikTok is certainly going to be the martyr of this situation, but we've got to deal with this at a very centralized level, and then set in place a very clear regime for all technology companies operating in the United States, not just TikTok, that will have to live within that regime. And ironically, a lot of the things that are being asked of TikTok in the United States were the same things that were being asked of Meta, at the time Facebook, and Google in order to operate in China. There's this narrative that there was a ban on those Western businesses from doing business in China, and therefore we should reciprocally ban TikTok. It wasn't the case. They actually laid out a set of guidelines and requirements. Now, those companies ultimately chose not to live by those, but those had very similar conditions around local ownership, local data storage, local government access, and kind of audit of that data. And so it's ironic now that we kind of experience similar conditions being laid upon TikTok that we saw the Chinese lay on American technology giants. And the funny thing is, they've circled back to it several times. I mean, Google, as recently as just a few years ago, even considered again relaunching a Chinese product. At the time it was called, I think, Project Dragonfly, and ultimately was a project that was kind of undermined through, I think, internal decisions taken largely by employees of Google. But all that is to say that if you want to play in any government's sandpit, the US or China, they're going to impose upon you a certain set of kind of data privacy restrictions that are very much domestic. And that needs to be uniform across all businesses.
So what you're saying is the privacy decoupling is still coming. Is that right? The decoupling, is that?
It's certainly, I mean, we have different systems, and those different systems need to be made uniform, and when they are, then, because we're going to have global companies that are cross-border, and China should accept companies just as Americans accept companies. There shouldn't be these kind of cross-border restrictions, but I think that's going to accelerate. And as I said, you're going to have social media and search and gaming and life sciences companies built for these kind of parallel ecosystems, unfortunately, eventually.
Dan, before you go, Gayad, can I see that again? Is your drink really that large?
So this is one of those, it's to help me drink a full gallon, right? So it has the markers, if you can kind of see it. I'm pretty sure this is
right? Of water.
Of water, yeah, no, this is not vodka. If it's vodka, I'm in trouble. I'm pretty sure, by the way, this is made in China, for whatever it's worth, so.
Pretty sure it is. So if you're, we'll come to the questions in the audience and after I ask this question, because it's maybe the obvious question. So, but I need to ask it. How do you feel like the breakup of Alibaba came about? I know what we read in the media, but you've got special insights.
Sure. It's an interesting one. There are a few of these names who kind of global investors have latched onto. Jack Ma and Alibaba are certainly one of them. Didi was one of them. There are a few other big names. The education space was another one that kind of, I feel like, are resonant themes that have become kind of poster children for China. And so anything that happens in Alibaba has significant scrutiny. In the case of Alibaba, I always like to tell people something, which is, if Alibaba existed if Alibaba had been built in America, it would have been broken apart today. And it's always interesting to me that there's this kind of, that again, global investors and American investors kind of use Jack Ma or Alibaba as a business that for which they have a huge amount of sympathy, and kind of again uses this martyr for the challenges that are facing large businesses in China. The reality is the Chinese government has very latently begun to enforce very standard Western practices of antitrust, anti-monopolistic governance. And it was historically, just up until the last few years, literally up until kind of 2020, that if you were, that China was a kind of a law of the jungle market where companies were growing almost unabated and were able to achieve huge market scale, unnatural monopolies over all kinds of different sectors. And we're able to do so with very, very little interference from the government. And so if you look at a business like Alibaba was imagine Alibaba pre-splitting out of Ant Group. I mean, this was a company that literally dominated every single aspect of your daily life. From the moment you woke up in the morning to the moment you went to bed at night, your food ordering, your financial services, your e-commerce, your ride hailing, your tax bill, your access card to get into buildings, your loan for college education. Everything you do was in that one platform. And so there was tremendous power held by that platform. So over the last few years, and it's not just Alibaba, Tencent have faced this, Meituan have faced this, anyone who had kind of an unnatural monopoly in the market have seen antitrust regulatory interventions, the likes of which we see every day in the West, particularly in Europe, the United States, with antitrust measures being taken against Google and Meta and Apple and others. So that is kind of, one of the undercurrents that you're seeing throughout all the tech majors in China, is an effort to appease regulators that they know are going to kind of be taking actions on the antitrust front. But also Alibaba and this recent split up makes a lot of business sense. It makes sense for those units because it enables them to be much more agile and nimble as they compete against a new wave of new consumer competitors. I mean, Alibaba had a dominant e-commerce kind of leadership in the market, and then JD came, and then someone like Pinduoduo cropped up out of nowhere and became at its peak a $200 billion company, not too far off of Alibaba's market cap today, e-commerce business. I mean, can you imagine someone building another $200 billion e-commerce business in America overnight to compete with the likes of Amazon? So they want that agility. They want that kind of entrepreneurial drive back that comes from, some of this separation. And likewise, I think global investors forget about how many assets these Chinese tech majors have under their hood, both in terms of business lines, investments. And so what we've seen is a lot of them, be it JD, Meituan, Tencent, et cetera, having these types of spin-offs to kind of remind the market, hey, you guys forgot how big we are. And the value of the sum of these, parts is not equivalent to if you separate them. And so, JD, for instance, which was the e-commerce giant, and we think of them as the e-commerce player, but they spun off a huge JD Health, kind of health and life sciences division. They spun off JD Logistics, a huge logistics business. They've spun off something called, in different names, JD Digits, JD Data, which is kind of their fintech and other kind of SaaS and IoT business. And so what Alibaba is doing actually is a little bit late to the game in terms of that spin-off type of activity done by a lot of the other Chinese tech majors. But I think it is largely in the interest of the investors, because each one of these units now, be it the Ali Cloud or the Ali Logistics unit, Sinow, they will each have independent IPOs. And I think when you add up all those IPOs someday, some of those parts will be greater than what they were today.
So before we want to open to some of the audience with their questions, but I have a very, very silly question. Like, do you remember during the period where Jack Ma disappeared? I'm just wondering, did you guys there spend as much time as we did wondering what happened, where he went, or is that just something we obsess about and is just normal daily life in China?
I'm so glad you asked this question, and it's a perfect example again of that information arbitrage that has accelerated, and that kind of opacity between China and the US and global kind of understanding of China. So, and I got this phone call all the time from our investors and partners around the world. Where is Jack Ma? What's happening, Jack Ma? Jack Ma had a lot of challenging conversations with regulators and with the kind of Chinese central government, and again, a lot of that was out of that this antitrust monopolistic narrative that I mentioned. Again, Jack Ma has kind of this very favorable view in the West, but if I think Jack Ma had grown up and built an equivalent business in the West, today people would think of him as a J.D. Rockefeller type character. I mean, he built a business that was a behemoth and controlled so much about the daily lives of consumers in a way that I think scared the government, scared the regulators. It was the equivalent of a business that was as powerful as many of the kind of non-business apparatus that existed in the market. But the ironic thing to us was there was this narrative that Jack was in jail and strung up by his toes, and we're literally seeing him physically. We're seeing him. I'm seeing him in Beijing. He's there. He's keeping a lower profile. He's obviously not, making the level of speeches or kind of engagements that he was prior, but he's there. He's, having a good time. The next minute I'm seeing he's playing golf in Spain, and he's traveling in Australia. He's been in Japan the last, period of time. He's enjoying life. I mean, being Jack Ma was not an easy job. And it was just a challenging. I mean, we saw, this all came to a head, that kind of information arbitrage. You saw there was probably about 2 weeks ago, there was this article that came out in Bloomberg, which said Jack Ma is shying away from China. And this is proof that that global investors should be staying away from the Chinese market because even Jack Ma doesn't feel comfortable coming back here. And Jack Ma was literally in China at the time when this article was written. And he had been actually, I think, even in Hong Kong for the last week at Art Basel or something. And at the time he was actually in Hangzhou, going around to kind of rural schools or somewhere in China, doing what he loves to do, which is helping to kind of build and invest in and support local schools, rural schools. So they had to kind of retract this article and edit it and change the narrative. But it's a perfect example of how you get certain narrative in the media globally, driven again by a lot of the kind of negative sentiments that have been pervasive about China, which is categorically and binarily false, and yet it's kind of taken as gospel, and only when something is very clearly kind of a gotcha moment like this do we get some catharsis from it. But it's a constant, steady stream of these types of narratives that we have to fight against. But again, it provides an incredible opportunity to those of us sitting on the ground. So here's a simple example. As I mentioned, one of the things that global investors pick up a lot on over the last few years was this issue around the Chinese education technology space, that China made a decision, a fairly public one, that a lot of these education technology companies would be turned essentially into nonprofits. By the way, if that sounds familiar to you in the US, it should, because most of our best universities are nonprofits as well. Most of our best schools are non-for-profits. They are not these kind of for-profit institutions that are trying to squeeze every dollar out of students and parents in order to benefit their investors. But that aside, this was an example of something where a lot of global investors said, we're shocked overnight. I can't believe that this entire sector could be washed off the map. For those of us on the ground in China, it was a very unsurprising development. And we as a firm, as MSA, never invested in the education technology space ever throughout our history, because one, we knew it was a very complicated kind of regulatory gray zone sector. And we had been told for years by our friends that were running K-12 schools and other things in the ecosystem that they were being told by regulators they weren't going to be able to sell their business, they weren't going to be able to exit. So we already knew there were some kind of serious questions there for years ahead, let alone there had been books written. I mean, Xi Jinping had talked about this in a book, and that, if you kind of listen carefully to regulators, they were already edging in that direction. And China is a very high touch market. It requires a deep degree of understanding on the ground, which again makes it so hard to sit in New York or sit in London and trade China. And finally, and more importantly for all this, education technology largely in China was a bad business. The unit economics were bad. The customer acquisition costs were never overcome by the lifetime value of customers. it just wasn't, they weren't great companies. People were investing in them because it was kind of like a get rich quick gold rush type opportunity for investors for a very short period of time. But it was kind of a musical chairs, and it was clear that people were going to eventually be left holding the bag. So as a firm, we didn't touch the sector, and we were unsurprised by the developments. But it's a simple example, and then goes exactly to your question about Jack Ma, which is if you're not sitting here, you're not physically seeing these people. I mean, we sit on some boards with Jack. We go every year to the Alibaba Foundation's kind of annual meeting where they, you know, for some of the charity initiatives he runs. You know, we have constant streams of communication with him and a lot of his other senior leaders. You have to have that, or else you're living in a black box.
So I guess you can't trust the media anywhere, which really pains me, to be honest. Let's go to Daniel, and then Eric, I don't know if you want to come up and ask your question after Daniel, or if you want us to paraphrase it, but you let us know. Daniel.
Yeah, thank you. So I have a question for you, Ben. So in the U.S. ETF market, there's about $35 billion across 60-ish ETFs. Yet when I speak to advisors, there's still this hesitation about investing in Chinese equities. So what do you think it's going to take for Americans to get over the perception that it's difficult or challenging to invest directly in China? How do we change that narrative?
Yeah, so I think, you know, it's got to come from transparency, and it's got to come from a place where you can provide those Western investors with a very clear stream of data and insight into what's going on in the market. And you have to kind of combine both what's coming out of the Chinese side and now what's coming out of the US side. So I spend a huge amount of my time also with American regulators and with American policymakers, people in Congress, people in the White House, understanding what's coming down the pipeline from the US side, because you've also probably seen a stream of announcements around restrictions on technology coming to China, talent coming into China, and you'll soon hear an announcement that will restrict some capital flows into China. And so our job as investment managers is to give our clients huge insight into what's coming down the policy tube in the United States and in China, and show how we are not being victims of those developments, but rather beneficiaries. And I think if you can provide that transparency and have the credibility to show over a track record of, you know, 10 years or so, as we have, that type of ability to navigate your portfolio around those shifts and provide transparency to your investors so they understand, those that are with you understand how you're doing it, why you're doing it, how you're staying months, if not years ahead of these developments, you can provide people with a much more secure feeling around accessing the Chinese market. So we partner with a lot of the key kind of political risk think tanks in the United States as well to provide our investors with that type of kind of analysis and foresight to see what's coming down the bend, because as I said, China's too big a market to miss. And so you can't trust putting your money with a manager who's sitting only in London or sitting in New York and kind of trading it from afar. But if you have someone that can kind of provide you with that transparency, and we also ask for that transparency from our partners in government on both sides of the Pacific, that they kind of provide better foreshadowing, better forecasting, and transparency as to what decisions they're taking and why, I think you can get to a stasis where even if these markets are separating and there's even, you know, constant narratives around conflict, you know, kind of cold conflict, that you can still get comfortable that this is an incredible market opportunity that you cannot miss. And if you can, and you can kind of navigate it effectively.
So
Thanks.
Eric's been very patient, but Ben, just be warned, Eric Connolly's always got great questions. So Eric, you want to come up and ask the question? You want me to paraphrase it? Okay, so I'm going to paraphrase it. I don't know that he's able to ask. Sometimes he's traveling as these go. You know, I think you just nailed it in a lot of respects, Ben, that we need transparency out of China, the same as we need transparency here in the US. But from a financial standpoint, first off, you know, they only report twice a year, right? As opposed to quarterly. You know, when you speak about transparency, you know, what's the journey going to look like on disclosures out of China?
It's a great question, and it's something that we have been cognizant of for a long time. I was sitting with, the Berkshire co-CIOs a few years ago, and I asked them, why didn't you guys participate in the Alibaba IPO? And they said, well, we don't trust, the data put in the prospectus. We don't trust any of the figures written on the paper. And there has been a growing mistrust of. And you gave me a softball, but I'll go harder, which is there was a mistrust of the data coming out of China. We had some of these kind of prominent fraud situations, like a Luckin Coffee. Not to say that we haven't had frauds in the West as well, but there were some of these kind of negative narratives that would cause one to lose some confidence in kind of the way that data was being reported. And ironically, it's actually easier for these Chinese companies to go public in the United States than in Hong Kong. One of the reasons why Didi elected to go public in the US rather than Hong Kong is because it required less disclosure. They could actually record some revenue that was kind of gray zone revenue as revenue on the US kind of standards, but not on the Hong Kong standards. They didn't have a lot of the operating licenses they needed in China that would have been reviewed and rejected on a Hong Kong IPO. But again, a US IPO allowed that. So I do think there was a perception from Western investors that maybe Chinese companies were taking advantage of even some of this lack of reporting and loopholes on the Western exchanges that enabled for some of these, negative narratives and negative case studies to emerge. I hope a lot of that has been assuaged, and this is very recent, but as you know, the American kind of Public Accounting Oversight Board folks were in Hong Kong over the last 6 months, reviewing all kinds of different Chinese company data that are public, and coming to terms with how comfortable they felt with that data, because there was this risk, towards the end of last year or in the middle of last year that there would be this, part of this decoupling. I mentioned decoupling would also affect public markets. We thought that there was a risk that Chinese companies would be delisted from U.S. exchanges, and some have, more of them more for kind of strategic or national security grounds, like a chip maker. But that was a huge risk to Chinese companies, because we want to be able to buy and sell Chinese companies that are listed in New York, not just Hong Kong or other onshore exchanges. And I think a lot of that is being assuaged. The American auditors were happy with the results of what they saw. But we hammer this home every day when we talk to the Chinese. And the Chinese, you see it if you read books like Hank Paulson's book on China, that he wrote about his dealings and helping to kind of build the financial regulatory ecosystem and that exists today, an asset management system that exists today in China. The Chinese are actually quite receptive to feedback when it comes to very concrete measures like their economy. And so we spend a lot of time with policymakers in China saying, you've got to be much more transparent. You've got to force much more rigor on your businesses. And they get it. One of the crazy things about that whole Luckin Coffee situation was the Chinese were more frustrated than the Americans because this company was listed in the US and not China, they didn't have the kind of oversight over it that they would have liked otherwise. And so that's why some of these companies like Didi were forced to delist from the US and come back to Hong Kong, because they feel like these guys are actually bad actors and they want to be able to enact more control over them because they see that their reputation is on the line. And it's been very interesting to talk to policymakers, particularly around issues like this, ed tech or other decisions. There was almost a degree of naivete where they thought that if they made these policy decisions around an Alibaba or around an ed tech sector, whatever it is, they didn't expect it was going to have the global ripples that it has. They thought it was kind of an internal problem. They were doing it for internal kind of policy enhancement and anti-monopolistic. And I think they, to some degree, naively thought that the West would understand what they were doing, but they didn't do a good job of explaining why they were doing it, foreshadowing or forecasting it, and giving global investors that confidence that this is a predictable economy. And once things stop being predictable and they start being kind of overnight binary shifts in sectors or companies, that makes the market uninvestable. And I think that message has been received loud and clear in China. And so I think we're going to see better communication with global investors, more transparency, more rigorous accounting standards and all kinds of different things, because they need global investors. They need global capital, especially post-COVID. I've never seen the financial kind of ecosystem of China from a government perspective so aggressive about going out to attract global capital. And they're not going to be able to do it if the narratives are that China is opaque, China is unpredictable, and we deliver those messages to them when we meet them at all levels of the kind of financial regulatory ecosystem, and they are highly receptive to that, and I think you'll see continuous improvement in that space. But that's a sector and space that is, to date, the likes of firms like MSA have had to bridge, and we've had to do that decoding. We've had to do that tea leaf reading to make sure our investors feel that they understand, for instance, the rationale behind these regulatory interventions and how to more effectively predict what's coming next. And we've developed a whole sense of frameworks to provide those for our investors. But I think it's been hard, but I think it'll get easier as we go forward.
Gavin, you want to jump in?
Yeah, sure thing. Hey, Ben. So I've gotten to know Ben a little bit over the last month, which means this is dangerous for him, unlike getting questions from most others. So Ben, I'm going to go off China here for a second. I'm going to ask you what your favorite soccer team is.
Well, so I guess some of you guys know that I've gotten involved with a Spanish soccer team 2 years ago. It's a team called Cadiz. For those of you who follow football or soccer, as our friends in America call it, we play in La Liga, which is the first division of Spanish soccer. So we're playing against teams like Real Madrid and Barcelona. I bought the team, or I actually got involved with the team 3 years ago, but public announcement too. And just 3 years ago, we actually got promoted to the first division of Spain. And in our first division, we beat, or first season in the top division. So that's the equivalent of your AAA baseball team getting promoted to Major League Baseball. So, you know, my Albuquerque Isotopes playing against the LA Dodgers. And in our first season we in 2020, 2021, we beat Real Madrid away, and we beat Barcelona with Messi on the field. And we continue to kind of have these types of like giant killing, we call it, underdog success. Most recently, just 3 days ago, we beat Real Betis, which was a top 4 team in Spain. And we play a Moneyball game. I mean, we have a payroll, this is all public, but we have a payroll of about 45 million euros for our team. We're competing against teams like Real Madrid that have payrolls of in excess of 650, 680 million dollars. So I always chuckle when I see that the beginning of the movie Moneyball, when they show this delta between the A's and the Yankees. I think it was 30 million or 35 million payroll for the A's and 70 or 80 million for the Yankees. I mean, this is child's play compared to the type of ARPA delta we have in our space, but we're still doing well to compete against them with modest means.
Ben's got a little bit of that like most interesting man in the world thing that happens. So as I've scratched the surface, I keep going and the onion peels and it gets deeper. So
I don't own soccer teams. I don't own soccer teams, but when I do, is what you're saying.
There you go. Sorry.
We apply the same logic to soccer that we do to investing.
Yeah, so that's a good, is the lesson here some great lesson on value investing, or what's the parallel?
Well, I mean, when I got involved with the team, I ran, it's funny, I think a lot of people are watching these shows like Welcome to Wrexham or others. I watched a TV show on Netflix called Sunderland Till I Die, which was about kind of the ownership and all the culture and what goes on behind a team in at that time, what was this, second and then progressively the third division in English football. But when I went into this process of acquiring part of the team, I ran a systematic process just like I would with investments, where I looked at a couple hundred teams across different levels. Because when in European football, you can not only you can buy in the first division, you can buy in the second division, third, fourth, and it provides you with huge data sets where you can kind of comp all kinds of interesting metrics. You can look at, the team's historic revenues, the scale of the market in which the team sits, of course, things like the legal challenges facing the team, the amount of debt it has on its books, the stadium and kind of infrastructure, the type of TV rights that it has access to, the sponsorship it's historically had access to, and you can model out. So I modeled out and looked at about 150 teams across all of those tiers, and ultimately settled on what I thought was the best value for dollar for me within that strategy, and that ended up being this team Cadiz. But it was a really fun exercise to kind of turn all of that data around teams and make it very quantifiable. not unlike what we do now as we assess players. And because, you know, think about it like this: if you're running an NFL franchise today, you have such a small universe of players you need to think about or worry about. You're only looking basically at the other people in the NFL and kids in college. When we're looking at players, we're sourcing them from a pool of, I mean, I think it's probably in the millions. Think about it. It's all the youth, professional, semi-professional players across 60 different countries around the world. And so we on our team have historically had players from Serbia and from Albania and from Uruguay and Brazil and Mexico and El Salvador and Australia and Ghana. And I mean, it's just an incredibly challenging pool of looking at millions of data points to kind of find that right chemistry for your right team. So I find it a really challenging but rewarding experience, but it can also be one of the most painful things in your life. If you lose a game one week, it basically ruins your week. Fans are not, fans in a football team are nothing like fans in a business that we would invest in. I mean, these people are so passionate and live and die by the team. And so if you're doing well, they, you know, carry you across town on a shield. And when you're doing badly, you fear for your life. But I got great advice. I have some friends that were kind of responsible for the renaissance that happened at Liverpool, which is owned by a group called Fenway Sports that I'm sure some of you guys know. And they told me, Ben, the well of public opinion about you and your team is drained every night. So it doesn't matter if you won the Champions League or the English Premier League title the season before, you're right back to zero, re-earning that trust. And I think that's a good lesson for investors too. I mean, regardless of our results over the last 10 years as a firm or whatever accolades we won over the last few years, we've got to prove ourselves again and again. And we go back to zero every year. And investors are seeing our ships just like our fans are seeing our ships week to week. Our investors are seeing our ships day to day now, as the public markets rise and fall. And so we've got to earn that trust over and over and over again. And I think that extends between football and investing.
I think that's a beautiful place to end. I have more questions about soccer, so I think I'll hit you afterwards because I'm really curious about a couple things. But thank you so much, Ben, for coming on the show today. Super interesting, your expertise and experience in China. Thanks everybody for joining us. That was a great show. And we look forward to seeing you next week, next Thursday live at 5. I don't remember who the guest is next week, but we will let you all know. Thanks everybody and have a great weekend.
Bye,
Thanks,
everybody.
Ben.
Have a good one.
Thanks for having me.
Bye.